So, ladies and gentlemen, when we talk of an employee, whatever you pay to employees, could be pension schemes, it is share-based payments. We have got basically two accounting standards that handle employee relations. The first one is IFRS 2. IFRS 2 is 100% dedicated to those companies that give their employees shares. It's called share-based payments. You know, we have, for example, Equity Bank. You must have seen Equity Bank just the other day giving their employees shares through what they call employees share ownership program. So they're giving employees quite a few shares. It will be like 5-6%. But the moment you are paying your employees in form of what here? Shares, share-based payments, at the end of the day, ladies and gentlemen, for services they give you, then you'll have to apply what we call IFRS 2. What if in this case here you have, for example, some pension fund? So that at the end of the day, when your employees, you're deducting them, say like 5%, most organizations will deduct 5% of our employee salaries. They channel towards what we call a pension plan, a pension fund. And then we'll have the employer himself contributing what here, 10%. So if you've got a pension plan, then how do you really account for this pension plan? Remember, the pension will be having its own assets. The pension will be having its own liabilities. So at the end of the day, how do you capture them in your financial reports? We normally account for that using IAS 2. IAS 2, which I would want to share with you this morning. So remember, it's advanced financial reporting. This is advanced financial reporting. And today I would want to dedicate this lesson here teaching what we call IAS what here? IAS 19. IAS 19. So could you kindly write that down? IAS 19. Great. Now, ladies and gentlemen, I would want to confirm with you whether you are able to see my screen called Chapter 12, Employee Benefits, IAS 19. Are you able to see my screen, my good students? Are you able to see my screen, my good students? Is there anybody who can see my screen? Employee Benefits, IAS 19. Employee Benefits, IAS 19. Yes, thank you very much. Employee Benefits, IAS 19. So first of all, we're looking at the pensions here. And then we have a jargon buster, these very heavy terms that you always get in your exams, jargon buster. So let us, in this case here, bust those jargons. So when a company sets up a pension plan, it will of course make contributions to the plan in line with the guidance of an actuary. When the employees retire, the plan will pay out benefits in accordance with the rules of the plan. Now listen and listen to me very well. It is the employer who is setting up what here? This pension. So we have the employer, the company. So the employer sets up the pension plan. So at the end of maybe every month, depending on the arrangement that they have with the employees, the employer will be doing what we call contributions. And then of course the pension now will be paying the pensioners, In this case here, at the end of the day, there will be some payouts when they retire. The pension plan will be paying some pensioners. But now remember, for the time being, this pension plan is holding whatever money they receive from the employer for pensioners as a liability. They must account for this liability that they owe the pensioners very well. Otherwise, they'll reach that time when these pensioners are going for retirement, and then the pension scheme may not be having anything. So it's very important to understand that this is a tripartite arrangement. We have got three parties involved. We have, in this case here, the employer, we have the pension plan, and then we have the pensioners. The role of the employer, of course, is to contribute to the pension plan. And then the pension plan, in this case here, will be making disbursements to the pensioners. Of course, the disbursements that the pensioners will be receiving at the end of the day really depends on, for example, years of service. So we'll be hearing a language like what we call service cost, right? This service cost will be service cost for the current year. And then we have service cost for the previous years. So service costs for the current year may be 10 million. And then, of course, for good organizations, ladies and gentlemen, they will at times be forced to work retrospectively. Retrospectively means what here? Looking backwards. So looking backwards means what, ladies and gentlemen, that given how inflation is really eating onto the pensioners' funds, at times, in this case here, you may be forced to have what we call an inflation adjustment parameter. So say that, fine, you guys have been working for us for the last 10 years. So whatever contributions that we have been having for you, retrospectively, we shall increase. So then that will be accounted for under what we call past service cost. You served us in the past, and we have gone in this case here to reawaken those figures. Ladies and gentlemen, here we are. So you're saying here, very important, you must have seen this in your exams, that there are two types of pension plans. We have the defined contribution, and then we have the defined what year benefit. Very important. So under defined contribution, this is where most of you who are in the private sectors are. Where in this case here, we have the employer having defined the contributions they'll be making to the pension plan. So they know, for example, that at the end of the month, I'll be taking Eric's 5% of his salary, and as the employer, I'll be contributing 10% of his salary towards this pension plan. So we define the contributions. So it is the contribution that we are only looking at as an employer. How much in this case here are we contributing? We don't even want to know whether that pension plan is going to be mismanaged or whatever. So as we are only looking at forecast on how much are we contributing, it's called, in this case here, kind of what here? A defined contribution. So you can only guarantee employees of the contributions we are making as an organization. And then now we have another scheme, like now the one operated by the government, where in this case here now we jump the gun, we jump this, and as an employer, guarantee the benefit. So as an employer, we shall guarantee what we call the benefit. You tell these guys that, like in the government, it's quite clear. You know that if, for example, you are in this salary scale, this job group, and then you work for 40 years, you know, for example, that you'll go home with 5 million. So the benefit is really defined. There are not many organizations that can go for this contribution, or rather for this defined benefit. I'll not advocate for it. Why? Because when you define benefits to be given to the employees, then you take up the entire risk. Remember, a pension plan is not required, is not actually allowed to retain lots of monies in their offices, to retain lots of monies in their banks. They are told in this case here to go and invest those monies here in assets, which should be able to return, right? Have what we call a return on investment, so that the pensioners' funds will be increasing. At times, when they make those investments offshore, they're making those investments in buildings, like right now, buildings, rental income is not doing very well. So at times, these guys may make a loss. So if you define the benefit, what would that mean? That when the plan is making a loss, you as an employer later on will be called to come and make good, will be called to come and make more contributions. If, for example, the pension scheme is mismanaged, what will happen, ladies and gentlemen, you as the employer will be called always when these guys are going for retirement. Hey, you've made this promise. You told these guys they're going to earn 5 million. If you don't honor the benefit, then they take you to court. More costs on you. So not unless you've got a big muscle like government, like in Kenya here, I know it's only the government which is defining the benefits. Otherwise, most of our employers define the contributions and they try as much as possible to outsource the services of what here, managing a plan. And they tell even the employees that, hey, we are not the ones who are managing your pension plan. Your pension plan is being managed by an India insurance company. It's being managed in this case here by ICEA Lion Group. Be attending their AGM. You have an obligation in this case of knowing, for example, at the end of every year, how much your contribution, how much you expect, or rather how much in this case here does your pension plan owe you. It's not your employer. So I don't know, ladies and gentlemen, whether with that explanation, are you able to distinguish between what we are calling a defined benefit scheme and a defined contribution scheme? Are you able to see some picture there, somebody? Somebody, are you able to see some picture there? Right? They're saying yes. Great, great. So under defined contribution, the employer is only responsible with the contributions they're making. But when you define benefits, you're putting yourself in this case here into what? You're into trouble, because trust you me, there is nothing, what I know amongst those particular institutions which are really, really mismanaged, where people will go there with this attitude of eating. It is this money lying here. Look at, for example, what we have at the old Kenya Railways. I mean, we had the staff who worked for Kenya Railways for 30 years plus. But right now, because of mismanagement here, ladies and gentlemen, what is happening? Those guys are languishing in poverty, right? And that is why I would want to call upon you great people. As you become outside there, of course, CPAs, most of you guys are going to end up being what here? You're going to end up being CEOs. Please ensure that you take care of your employees' future by ensuring that there is nothing that is going to be mismanaged here. Even if you're going to be eating, because some of you I know, you're going to be corrupt. Don't eat money over retirees. It's quite hectic. Retirement life outside here is hectic. Don't eat money belonging to pensioners. Eat any other money, but don't try the pension scheme. Of course, my students cannot be corrupt. That's just but an example. Great. Now, ladies and gentlemen, here we are. So we are told here that in a defined contribution plan, the company promises a level of contribution, e.g. 5% of salary, but no guarantee is given of what benefits may ultimately be paid out by the plan. The employee takes all the risk. In a defined benefit plan, the company promises a level of benefit based on years of service and the salary while in service. In this case, the company faces uncertainty over the level of contribution that will be required to fund the benefits. Thus, the company takes all the risk. Note number 6, which is very important for your exam. You are not going to sit for an actuarial exam. Actuarial exams are very difficult. That's why actuaries are very bright people. So don't worry too much about the terminology. All that matters is that you recognize the term, e.g. service cost, and know where it should be shown in the financial statement. So we have here defined contribution scheme. For a defined contribution scheme, ladies and gentlemen, as an employer, defined contribution scheme, what really is my role here, right? So under defined contribution scheme, I'll basically be accruing whatever contributions that I should be paying to who? To the pension plan, right? So I accrue them like liabilities, right? And then of course, at the end of the day, if you're going to be making any payments to our retirees, what do? It's quite an easy thing. We expense. So basically, ladies and gentlemen, defined contribution, there is nothing to teach you really. But when we come to the defined benefit, for those organizations now that have got defined benefits plans, so you're saying here defined contribution, first of all, contributions are accrued in the financial statements with an expense recognized in the profit or loss. I'll be able to show you how this is done. And then we have now the defined benefit scheme. So the statement of financial position extract, what do? You look at the end of the year. What is the fair value of the scheme assets given to you by the actuary? What is the fair value of scheme liabilities at the end of the year? So in this case, you subtract, and then you should be able to get the net pension asset or liability like that. And then, ladies and gentlemen, we have something very important here. We have the statement of profit or loss and other comprehensive income. Remember, under P and L, ladies and gentlemen, what are we supposed to account for under P and L? Very easy. Under P and L, this is normally what we do. Under profit and loss, and of course, other comprehensive incomes. Other comprehensive incomes, so statement of profit and loss, statement of P&L, statement of P&L, should write down here a bit, statement of P&L, and other comprehensive incomes. Where do we take this defined benefit parameters? Very easy. We are going to have under operations. So we have here under your operational cost. Under your operational cost, you shall have the current year service cost. These must be shown separately. Current year's service cost that you must show, right? And then, ladies and gentlemen, we have here what we call the past service cost that you must show. Very important. The past service cost you must show, right? And then now you go to the financing cost. So we have the financing cost. The financing cost, you must come and give us the interest. The interest. Now remember here, for the benefit scheme, ladies and gentlemen, a pension plan is very independent. A pension plan can even be a different registered company, like how you see for KCB. The pension plan is a different entity. So you contribute, then the pension plan in this case here takes over. So this pension plan will be having its own assets, the scheme. It's like a different company. It has its own assets, and of course it has what here is liabilities. So for the liabilities, we shall be assuming that all its liabilities are loans, including the liabilities that they owe to pensioners. Any liability it has, it's a loan. So we'll be taking in this case here the rate of interest prevailing, like the treasury bill rate. You multiply with that the total liability, right? And then, ladies and gentlemen, here under financing cost, of course, here we're going to have under financing cost, we're going to have here what we call return on investment. It's form of a financing cost, return on investment. Now, the same percentage that you used here is the same percentage you shall take here, and then you multiply this with the assets of the plan. Because remember, as I told you, a pension scheme, ladies and gentlemen, cannot just have their money lying in a bank account. You must invest. So when you invest, you're going to get a return on asset. So this return on asset, you'll come and deduct it from here like that. So to be able to get your net financing cost, as you shall see in a question. And then, ladies and gentlemen, we have other comprehensive incomes. So who can tell me, when somebody mentions other comprehensive income, you as an accountant, what comes to your head? What comes to your mind? When they talk of other comprehensive income, what comes to your mind? And you'll be asked this question one day when you go for interview of being a CFO. A CFO, when they talk of other comprehensive incomes, what comes to your mind? What comes to your mind? What comes to your mind? Revaluations. So the plan assets, the plan liabilities must be revalued. You must bring in an actuary who will be able to revalue. And then, of course, once they are revalued, any gains or losses shall come under what we call OCI. So under OCI, you're going to have the remeasurement. Please write here, we're going to have the remeasurement, gains or losses. The remeasurement, gains or what here? Losses. Remeasurement, gains or losses. Now, can we go to a question? Are we ready now to tackle a question? Are we ready to tackle a question? Are we ready to tackle a question? Are we ready to tackle a question? Yes, yes. They're not talking to me very well this morning. I don't know why. And yet I'm teaching them something that is very important. So in this case here, we're looking at a question. So we have here a defined benefit scheme. Finland operates a defined benefit pension scheme for all of its employees. The closing balances on the scheme assets and liabilities as at 31st December 2014 were 60 million and 64 million respectively. Finland actually has provided the following information that has yet to be accounted for in the year ended 31st December 2015. So I can see we have current service cost. I can see we have got past cost, contributions paid in, benefits paid out, fair value of plan assets, fair value of plan liabilities, and then I have got yield on high quality corporate bonds. This is what I'll use to calculate the interest. So they want us to calculate the amounts that will appear in the financial statements of Finland for the year ended 31st December 2015, for the year ended 31st December 2015. Great. So, ladies and gentlemen, when I get this kind of a question, it's quite all over in your past papers. When I get this kind of a question, what am I supposed to do? This is a straightforward question. I'll go there and write a big title. I'll go there and write a big title. So you guys, are you able to hear Mwalimu? Somebody's complaining about my sound, my audio. Are you able to hear Mwalimu? Is it me or his audio? Yeah. So he's judging me wrongly. Please change your internet provider. Change your internet provider. So what I'll do here is a working, very easy. It's a 5 minutes thing. I'll come and do a working here. I'll come and do a working here. So in my working, I know if it's a defined benefit scheme. If it's a defined benefit scheme, I must look at the assets of the scheme vis-a-vis the liabilities of the scheme. Liabilities of the scheme. So then what you'll need to do, you'll come here straight away. You'll come straight away and bring down the opening balances. That is what you do as an accountant when you're doing financial reporting using Excel or using SAP, whichever tool. So come here and give me the opening balances. Opening balance, closing, or other opening balance also for liabilities. Opening balance. So has this examiner given me the opening balances? Oh, yes, he has done this. Opening balances, opening balances. So opening balances, they have told us here, the closing balances on the scheme's assets at the end of 2014. You see, now we are in 2015. So closing balances of 2014 must be the opening balances of 2014. All right. So for the assets and liabilities respectively, we have 60 and 64. That's a mark, low-hanging fruit, 60, 64. Low-hanging fruit. Great. Now, ladies and gentlemen, what is it that will make my assets grow? These assets that we bring at the beginning, we bring forward at the beginning of the year, we need to invest them like immediately. And when you invest them like immediately, then they must earn a return. So we have a return on investment. So we have ROI. I hope you guys are used to this ROI. ROI must increase my assets. So ROI, who can talk to me this morning and tell me which percentage am I going to use here to calculate my ROI? Which percentage am I going to use to calculate my ROI? Which percentage am I going to use to calculate my ROI? Is there somebody who is able to see any treasury bill rates or like this yield on high quality corporate bonds? It's here, 5%. So I expect in this case, ladies and gentlemen, that my assets which I invest outside of there will be able to earn me an interest that I'll call return on investment, just like what here those high yielding bonds are providing. So then this will be return on investment will be 5%, 5% of 60. So what is 5% of 60? Somebody give me this figure. 5% of 60 will give me how much? 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 You guys, please give me figures here. Eric tells me it is 3. Thank you very much. Now, remember for liabilities, for people that we owe, who mostly are our pensioners. Who are our pensioners? So we shall assume like they have lent this money to us. We must pay them interest. So on the other side of the coin, for liabilities, we shall pay them interest. Interest, of course, at the same rate, 5% of 64. 5% of 64. 5% of 64, is there somebody who is able to give me what is 5% of 64? 5% of 64, is there somebody who is able to give me this figure? Right, so this gives me 3.2. Both of them are positives because they're increasing their respective what year metrics. Right, 3.2 or 3.3, somebody. Is it 3.3 or 3.2? 3.2. They're confirming it's 3.2. Thank you very much. Now, ladies and gentlemen, from there, we read whatever has been given for the year, the changes in the year now, apart from the interest. Like now, they have given me current service cost. As these employees are serving me, of course, they are growing my liability. They're growing my liability towards them. The more they serve, the more my liability will be. So in this case here, I've got a current service cost and liabilities. You record these under liabilities, current service cost. We also have in this case here, the past service cost. And I explained what past service cost means. So don't tell me that this past service cost has been accounted for in previous years. No. Remember, it is in the current year that we sat down and re-evaluated and said that retrospectively, looking backwards, let's in this case here honor our people by increasing whatever we owe them. So all that will be lumped into this year's account. So in this case here, current service cost, what do we have here for current service cost? So for current service cost, we have, ladies and gentlemen, 9, and then the past is 8. So 9 and 8. So we have here 9 and 8. So current service cost, we have 9, we have 8. The increasing liabilities. So we shall not in this case here deduct them. They shall be positive. They shall be positive. All right. Now, ladies and gentlemen, after that, we have the next one, the next item here. The next item is contributions paid in. What do you think of these contributions paid in? Where should I take these contributions that you are receiving from the employer? Remember, I gave you a tripartite arrangement. We have the employer, we have the pension scheme, and then, ladies and gentlemen, we have what here? We have the pensioners down there. So you as the pension scheme manager, when you get contributions from the employer, that is cash in. That's an asset. That's an asset. So contributions in. So contributions in. So contributions paid in, 5. So contributions paid in is 5, like that. It's an asset. So you move on to the next thing, ladies and gentlemen. You move on to the next thing. So the next thing, what do we have here? We have benefits paid out. When you pay, benefits paid out are very interesting. I love these benefits paid out because even when we are teaching this in practice, you get people asking so many questions and really there's nothing to be asked there. Benefits paid out, number 1, they reduce your assets. Asset goes down. So we have your benefits out, benefits paid, and then we have benefits paid here. It appears in both assets and what here? Liabilities. So benefits paid. So benefits paid, it is 6. So 6, 6 like that. It's a deduction, I'll deduct, and I'll also come here and deduct like that. Remember, when I pay my pensioners, what happens? My liability goes down as well. So the asset, because of the cash, will be going down. The assets will go down, and the liabilities will also go down. So for benefits paid out, you can even close your eyes and mark it very fast. That benefits paid out will appear under the assets and what here? Under the liabilities. You deduct like that. You deduct like that. I don't know whether we are in agreement there. For benefits paid, it has to go to both accounts. It is the only one which goes to both accounts. Benefits paid, are we in agreement? Yes. So now we go to the last one. Great. So we go to the last one. So the last one, what are we being told here? Nothing really. These are the plan assets and plan liabilities at the end. So could you kindly give me the expectations? What is the expected assets at the end? So expected assets at the end. Take this plus this minus 6. Give me a figure. So from Bernard, Lucy, 62. How about in this case here, expected liabilities? Expected liabilities. Can somebody give me these expected liabilities? When you add them, this plus this plus this plus this minus 6, what are you getting? Somebody here? Expected liabilities, 78.2. 78.2 like that, 78.2. So in this case here, what are the assets carried forward? Assets carried forward. And remember, these assets carried forward must be given to you by the actuary. By the actuary. And also we have here liabilities, liabilities carried forward. These must be given to you by the actuary. Right? So the assets in this case here carried forward, ladies and gentlemen, the assets carried forward. So you can see a plan assets here were what here? 66. And the other one 75. So 66 and 75. 66 and 75. 66 and 75. 66 and 75. Like that. So could you kindly give me the remeasurement? Please give me the remeasurement. Give me the remeasurement change. So the change here, the change, the remeasurement. So you can see we expected to have assets worth 62. But I mean, when this guy came and revalued, he got 66. Is there somebody who is able to see that change? The change of what here, somebody? This is what we expected. This is the actual 66. It's a change of 4. So this remeasurement is a gain to the pension plan. It's a gain. Please write there, this change, remeasurement is a gain. Is a gain. Write like that. It's a gain. How about this other one here, the change? The change in this case here, the remeasurement. The remeasurement, somebody is giving me a figure of what here? 3.2. 3.2. Somebody is giving me a figure of 3.2. What I will be interested in under the remeasurement, what I'll be interested in, ladies and gentlemen, is to know whether this remeasurement of the liabilities, is it a gain or a loss? Is it a gain or a loss? Please talk to me in the morning. Please talk to me in the morning. Is it a gain or a loss? Yeah, it's a gain, isn't it? Because our liabilities have done what you reduce. When your liabilities reduce, that's a gain. When they increase, it's a loss. Here, we expected to have more liabilities as compared to what we actually had. So in this case here, this is what here? A gain. This is a gain. So then could you kindly give me the total remeasurement? The total remeasurement will be 4 plus 3.2. So mention somewhere there, total remeasurement, which will go to my OCI, other comprehensive incomes. So total remeasurement, in this case here will be 7.what here? 7. Which will be 4 plus 3.2. Now, ladies and gentlemen, listen to me very well. When you do this working like that and then you leave it like that, we are going to give you 0 marks. Because what we wanted you to do at the end of the day are financial reporting extracts. Would want you to tell us how will this component here appear in the statement of profit and loss? How will it appear in the statement of what here? Financial position. If you leave it there, I mean, you'll not get many marks. Actually, it should give you 0 because you have not answered any question, right? This is just better working, right? So now you need to come here. Ladies and gentlemen, you need to come here and really look at this. Calculate the amounts that will appear in the financial statements of Finland for the year, or they just wanted us to calculate. But whenever they want us to show extracts, ladies and gentlemen, this is how you show your extracts here. For example, the profit or loss, statement of profit stroke loss and other comprehensive income extract. You must give us operational cost or operating cost, show the current service cost, show the past service cost. And the financing cost, show us the interest expense, show us the ROI. And then, of course, other comprehensive income, you'll be able to give us the remeasurement what year gain. So let's show them, ladies and gentlemen, a statement of P&L. I hope you guys will be able to remember this. After all, what do I need here? I will need this ROI. I will need that interest. I will need the remeasurement gain. I will need the service costs. So mention there statement of profit or loss, statement of profit or loss, and other comprehensive incomes, right? So here we have operating cost, very important. So operating cost, during operations, you must show us the service. How were these employees in this case here serving us? So we have here the service cost, current service cost, and then we have here the first service cost. So is there somebody who can give us these figures? Current service cost from your workings. I hope you remember these figures. The current service cost from your workings, what do we have? So we have 9 from Sharon. How about the past service cost? How about the past service cost? 8. Thank you very much. So those are the only operational costs that you show. From there, we go to the financing cost. So under financing cost, the standard IAS 19 requires us to show 2 things. Number 1, we have the interest paid. So from your liability section, is there somebody who can remember 3.2? Is there somebody who can remember the 3.2 interest? Yeah, and then you must come here and give us the return on investment. Return on investment, what are you able to see there? Return on investment, what are you able to see in return? 3. So of course these, because we have called this a cost, so the return on investment has to be in brackets. That's what the standard tells us. It has to be in brackets like that. And then now we have this other component. So mention there other comprehensive incomes. Other comprehensive incomes, OCI, give us the famous remeasurement gain. Give us the famous remeasurement gain, which you got as what here? Remember, ladies and gentlemen, you must also demonstrate there that this is what here is an extract. Is an extract. So when you go to the disclosures in your financial statements, notes to the accounts, you must have a whole note on the pension plan. And this is what you're going to show there. You must have a whole note on the pension plan, and this is what you shall show there, because you must expound on how do you get the figures that are shown in the financial reports. And then now we have the statement of financial position, really. There is nothing here, statement of financial position. So 2 things, extract. So we have fair value of assets, scheme assets or pension assets. Then we have fair value of liabilities at the end of the year. Remember, this has to be at the end of the year. The figures that you wrote in the workings there, the figures that you wrote what year as carried forward, the ones that were given to you by the actuary. Right? So fair value of assets, ladies and gentlemen, fair value of assets, ladies and gentlemen, are you able to see the fair value of assets here? Are you able to see the fair value of assets? Are you able to see the fair value of assets? So fair value of assets, 66. And the fair value of liabilities, so what here, somebody fair value of liabilities carried forward. Remember the figures that we carried forward. The fair value of liabilities, what are you able to see there? The fair value of liabilities, what are you able to see there? 70 what year? 75. So thank you very much. I'll be able to upload this particular video on YouTube. And please, when you go to my YouTube, ensure that you are able to do what here to subscribe. You should be able to comment. How do you promote your mwalimu? Which mwalimu can wake up at this time here to be of help to you? So promote me by commenting, liking, sharing this with your friends. That really will be so happy.